Hello, this is Paul Gibson with the Academy of Trading and Investing. We're back today talking about technical analysis. We'll be covering Lesson 6, or the topics contained in Chapter 5, in Notes from a Profitable Investor. Today we'll be talking about upper studies. We're going to be learning how to read price charts using Bollinger Bands, simple and exponential moving averages. We'll also take a look at the Parabolic SAR. There are other indicators available to you, but these are some of the most popular and widely used and some of the most effective and my favorites. So let's get started. Notice that we have a histogram here that shows the volume of stocks being traded. And sometimes these spikes in volume can be an indicator of potential trend change. For example, here we have a bullish spike, lots of stocks being purchased. But we also get a candle that indicates potential for trend change, a black candle. Sure enough, we get a trend change that goes into a bearish function after that. Black candles usually indicate potential for trend change. Here we see two black candles together, strong potential for trend change, but then it didn't change. So these indicators indicate that these things are usually going to happen, but not always. Let's take a look at the Bollinger Bands. There's the bottom Bollinger Band, there's the top Bollinger Band. These indicate that within those bands, the price function will fall there 93.7% of the time. The probability of getting outside the band is quite low, less than 7%. We do see that the prices do get outside the band occasionally, but the probability is quite low. We can also see that when the prices start piercing the band, it's an indication that the trend is getting ready to change. This line in the center of the Bollinger Band is the 20-day simple moving average. It shows us where that price averages. I had a friend explain to me that we could see the Bollinger Bands as the shores of a river, and that the candles are little cavemen trying to get back and forth across the river. And the center of the river is the 20-day moving average. That little caveman is going back and forth, trying to get back and forth, staying in the middle of the river, having a hard time doing it, bouncing around in all the currents. Nevertheless, that shows the general stream of the river. These can be seen as artificial support and resistance lines. That's how I use the Bollinger Bands. Once again, as the prices pierce the band, it's an indicator of potential trend change. When we're in the middle of the stream, it's difficult to know where that stock price is going to go without some additional studies, which we'll get into. Now we're going to compare simple moving averages. This green line is the 13-day simple moving average. The red line is the 20-day simple moving average. The blue line is the 50-day moving average. 50 days represents 2 months of trading period in the stock market. 20 days represents 1 month of trading days in the stock market, and 13 days indicates 2 weeks of trading days in the stock market. We can see that there's some dynamics going on here. As we have crossovers of those lines, especially the 13-day and the 20-day, that's an indication of trend change. It's a confirmation. As I mentioned before, all of these lines are trailing indicators. They come along and pick up the data and average them out. And we see a few days after the trend has actually changed that we get the crossovers. Those are confirmations. Now, if you were a conservative trader, you would wait for those confirmations before you made up your mind about which direction to go in. So at this point is when you would decide to do a bearish trade. At this point is when you would decide to do a bullish trade. The candles have already indicated there's been a trend change. There's a doji there. Almost a doji there. Doji there. We're getting some indicators of potential for trend change all along the way. We're picking up the signs and reading this as we go forward. Let's now take a look at a shorter term. The 18-day simple moving average the 13-day simple moving average and the 20-day simple moving average. This gives us a shorter time frame. We're going to imagine that 8 days is a much tighter time frame and will give us a little more advanced indication about what the stock market is going to do. As you can see, that 8-day moving average takes a turn downward sooner than the 13-day or the 20-day. If we're trading short periods of time with options or during short-term buy and sell trades, what were called swing trades, we would then have an indication of those trend changes and potential for further movement in the market. Once again, you can see these points of crossovers, which would be an additional confirmation of trend change. We'll now take a look at exponential moving average versus simple moving average. So we have the 20-day simple moving average and we have a 20-day exponential moving average. The exponential moving average puts more weight on the more recent data or stock price movements than the simple moving average. With the 20-day simple moving average, we merely take 20 days of price data and average it all out. With the exponential moving average, we give more weight to more recent days, which gives us a little bit more of a heads up or indication sooner than we might otherwise get. This helps us to see the potential for changeovers. Let's now talk about the Parabolic SAR, which stands for stop and reverse. As you can see, we have these support line dots, which indicates a bullish function when the dots are underneath the candlesticks, and we have an artificial bearish or resistance line, which indicates that the market is going down, or a bearish function. Once again, whenever we get these gaps in trend change, when the dots move from above the line to below the line and from below the line to above the line, that indicates a trend change has already happened, another trailing indicator. So let's put it all together. Let's see if we can find some potential days for trading. Well, we have a bearish signal there. Once again, a confirmation that the market has changed. And there's a bullish indication there. Confirmation that the market has changed. Another bearish indication. And another bullish indication. There may be more on this chart. Take a look closely and see if you can figure out when those other indications are. Basically speaking, if you're a conservative trader, you would wait for those indications before you would actually place a trade for bull or bear markets. We hope this has been helpful to you. Once again, this is Paul Gibson with the Academy of Trading Investing. Let's get ready to buy or sell stocks or options. Let's study up. Start practicing today. More information is available on Notes from a Profitable Investor. There's also the breakout book, Technical Analysis, which just takes the technical analysis section out of the book. It's a little less expensive, a little more type focus. I recommend the full book to give you a better indication, and it has more footnotes in it. But whatever you choose is good for you. It's available for Amazon.com, and it's also on Academy of Trading and Investing, academyofti.org. There's additional articles and information there. If you sign up, you'll get a free email coming to you with market information and latest news media releases. A lot of good information there. We'll look forward to seeing you next time.